Alright, so welcome back everybody to another video. In the last video we spoke about support and resistance, how to locate a support and resistance area, and basically how we trade at support and resistance zones. But one thing to always is looking for your support and resistance zones, you should always use the largest or the larger time frames, like the 4-hour or the daily time frame. And that's because you'll have like less areas to mark up, but it'll be more significant areas. For example, there on the daily, that's a very good support. What the heck? Yeah, so this is a very good support. You use the 4-hour chart to... Alright, so now that we know the time frame which we should use to identify our support and resistance zones, there's something else I actually wanted to talk about in this video, and that would be the Fibonacci retracement. And what I've learned from trading Forex thus far is the Forex market basically moves according to Fibonacci retracements. So for the fib, however, you want to mark up one fib on your larger time frames. For example, let's use right here. So we got a fib retracement from a swing low, which would be here, to the swing high. Oh my god. Alright, from the swing low to the swing high. Alright, so the price broke this support. You can let me just mark it out for you. So yeah, this is the support line right here. You can see here and here, and it was broken, so it's beginning to make a new structure. So from the low to the high, this is supposed to have a 70%, but the principle is when you mark the Fibonacci retracement, and if you are looking for a buy, then the 100% is going to be at the bottom. What you're looking for is a retracement around the 61.8, or some people might have their Fibonacci retracement at just 70%, so it won't have an 88.6, 78.6, or 61.8. You'll just have the 50, 38, 12, 0, and 17, and they'll have 100. So the idea is, once price bounces off of the either swing low or swing high and touches the 61.0 or the 70, then you go in for either a buy if it's moving up, or in the case of moving down, it'll be a sell. I'll show you a sell in a minute, but let's just shoot this. Okay, so the price came down here, it went all the way up to the 23.6, but that wasn't our zone, so we waited until price came down to touch the 61.8 like it did here, and then we went for the buy. You could have taken profit at the 23.0, or you could have even waited for the touch of the 0%, because it did wick there. However, my strategy is just about 10 to 20 pips, no more, so it most likely would have been anywhere around the 38.2 or 23.6. Alright, let's see if we can find another one, maybe a sell. Oh crap. Yeah, swing high, to the swing low. After price came back up to create the structure, this is the highest point that it touched. So that's why we started our Fibonacci retracement from there. And the lowest point it touched before it changed the direction would be here, because this is a low point and so is this, but this is the lowest point. So that's why we use the swing low. And what we notice is it bounced off of there and touched our 78.0, and that would have been like, for example, with the other one where it touched the 61.0 and you went for a buy. In this case, it touched the 78.6 and it went for a sell, because you can see the charts lined up next to each other. This one is for a sell because we traced it from the swing high to the swing low. This one is for a buy because we traced it from the swing low to the swing high. So it's basically using the same technique in reverse, depending on whether you were looking for a sell or a buy. And as we see here, price touched our 78.6 and went straight on down to our take profit at 38.2, or some would have taken it to 23.6. I wouldn't advise letting every trade run to the 12.4 or 0, because sometimes you can be either at a major support or resistance area on the larger time frame and it won't make it that far. It'll just sometimes give it a wick and go back in the other direction. So taking what the market gives you instead of looking to make a certain percent or a certain amount out of the market would be the only way you'll be consistently profitable. Alright, another important key factor that I was wanting to point out. Oh, by the way, I'm on the 4-hour chart marking up these zones. So if we should make it down to something like the 15-minute chart, this one here, it was a sell on the 4-hour. So coming down to the 15-minute, if you are a scalper or so, then you will want to make sure that the direction that you're seeing on the 4-hour is aligning with the direction that is on the 15-minute. So for example, when it came here to the 61.8 on the 4-hour, we bought, and in this Fibonacci retracement on the 15-minute, it's actually in that uptrend movement, so it's actually aligning with the 4-hour Fibonacci retracement. That's what you also want to make sure. You don't want to see a buy on your 4-hour and then when you come down to the 15-minute, it's telling you to sell, or it's, you know, in the opposite direction. You want both retracements to line up, and that'll give you like a more solid confirmation and a stronger entry. Alright, one thing that always helps me when trading, like for example, you might open a trade and it's almost at your take profit, and you may want to close, or it might be like 10 or 20 pips away from your take profit and you want to close. But one thing that always assists me in letting trades run as long as I'm at a key level of support or resistance is my zones. So let me just go ahead and mark up these zones for you. Alright, so let me just mark up these zones for you. So we're on the 4-hour. Alright, so this is a wick, and this area looks like one. So the principle of identifying your zones is you draw it from, you draw a box from the top of the candles to the tip of the wicks, and you just extend that box out into the future. And these zones will tell you where the price is thinking of retracing to. This looks like one right here in the middle here. Your zones, you're never wrong or right with your zones. It's just the areas in the market where price respects. It might not reverse at your zone that you mark up, but it might show some type of maybe consolidation before going through. It might show like a wick, meaning like, you know, the price was here, it reversed a bit before it continued going up, and it respected that level. So the levels just kind of help you determine where the price may respect, so you can either not close a trade that you just opened and maybe you're in a little drawdown and you're thinking that maybe it's gonna hit your stop loss, then let it hit your stop loss. Don't just close it because you think it's gonna hit your stop loss. Many times the trades just go a little bit against you and then reverse into your favor. Yeah. Excuse my trying skills. It's not that 100%. Alright. Yeah, so these are my zones, and what it's telling me is, should I do a fib retracement, for example, from this swing high to that swing low right there? Good. What it's saying is, should I take a buy? My bad, this is a buy, and I drew it from top to bottom. The swing low, which is right here, to the swing high, so we can basically extend. Yeah. Alright, so from the swing low, it's still in this same Alright, so what it's saying is, from the swing low, if we had taken this trade here, if we look to the right, we have our zone extending all the way here, right? But what it's saying is, if we had taken this buy from this zone right here, the 61.8, then we could have left the trade running until this zone. That's what marking up the zones do. It like increases your confidence in your trade, so you don't just close and leave some profit, or you close short, or maybe you just want to break even, because you see sometimes the market will go up here, and if you're looking to take it at the zero or maybe a little bit beyond up here, because you don't have a zone, you don't know where price is going to reverse, then price went straight here just before your take profit and reversed back to break even, and then you might be like, oh my gosh, I lost all that profit, and now it might go in negative or what's not. So marking your zones out, they're always important, and use it as long as you stick to the rules of this strategy. You follow all the steps, you don't skip anything, and you follow it like step by step. You're gonna be consistently profitable. You don't take every trade, because you're gonna miss some setups, because as long as you stick to only if the price should break the new structure, that's one. You come out on a larger time frame, like the 4 hour, the daily, you do your Fibonacci retracement, the price bounced off of your swing low or swing high and retraced to either the 61.8 or the 70. The 61.8 or the 70. I think I made a mistake earlier where I said the 78.6, but no, it's the 70. It's somewhere like here. However, as long as the price retraces to touch there, then you go in, as long as it's aligned with the 15-minute Fibonacci as well, then it'll be just fine. Alright, and just a short video for this one. Alright, so just a short video for this one. I'll see you guys in the next video. Thank you so much for watching. Don't forget to like and subscribe if the video brought any value for you, and I'll see you in the next one.